the Fed at, which is in effect, the Fed monetizing it as you've described. The Fed balance sheet will grow, and yes, I mean this will be, one, inflationary, and two, it'll be rocket fuel for the monetary metals. I mean.
Larry, you were talking about the wave of debt that's coming. The U.S. is running these historical fiscal deficits. The massive wave of at least $9 trillion is maturing and coming, needs to be rolled over at much higher costs, unless they dramatically lower rates, but all signs are pointing to them not doing that, at least dramatically. With all that's happening geopolitically and economically around the world, are there even enough buyers for all of this issuance? And if not, doesn't the Fed have no choice but to monetize most of it? And if they do, what happens to the rates and to the dollar?
Yeah, so I think I'm with you on all those things. I think there are not enough buyers. I think over time the buyers are slowly but surely backing away. We've seen China slowly selling. We've seen Japan slowly selling. And you're going to see, U.S. and domestic investors selling as well, because they're going to realize that there are better places to be. I think the way they handle it is they'll probably change the rules. ISDA floated a letter that talked about maybe a rules change for the banks and what the banks could hold as reserve assets. And basically they'll get the banks to buy them, and they'll do that by loaning the banks money at a lower rate and letting the bank clip the spread between what they buy and what they can borrow from the Fed at, which is in effect, the Fed monetizing it as you've described. The Fed balance sheet will grow, and yes, I mean this will be, one, inflationary, and two, it'll be rocket fuel for the monetary metals. I mean, everything that can't be printed will go up in value, and even arguably real estate, right? The problem with real estate, from my point of view, is just you can't move it, and they can tax it, and so when you're looking at places to save your money, I know people have done very well in real estate, and I'm not totally opposed to it. I just prefer the monetary metals for the liquidity and pure savings.
Yeah. So you mentioned earlier about the unemployment rate in the Sommerl. The 3-month unemployment rate average has risen to 4.1%.
Correct.
More than 50 basis points above.
Is it more than 50? I thought the Sommerl hadn't been triggered.
Just slightly.
Okay.
Yeah, above its 12-month low of 3.5%, triggering.
Okay.
So it's
it's
on that.
It then. Yeah, well, then it has. I saw somebody say it hadn't, but whatever. It's close.
Yeah, I mean, it's on the line. I mean,
right.
It's real close, right?
Yeah, right.
So the Sommerls accurately marked the start of every single recession since 1950, except for one false positive.
In 94, yeah.
Yeah. So former Fed insider Daniel DiMartino Booth, you might have watched her at the Rule Symposium.
I did, yeah.
Because she agrees. She's saying that the recession began in October of 2023. So, Larry, in your analysis, are we already in recession? How deep the recession will it go? And in your analysis, how high do you think unemployment will go this cycle?
Oh boy, a lot of tough questions there. I don't know. Look, I think we are, on a real basis, I think we are in recession. I think we're printing bigger numbers, but that's because of the inflation. I mean, if everything, if we're not selling more goods and services. We're selling the same or less goods and services at higher prices, which make you think the top line is growing, but it's not. Okay, so for starters, yes, I believe we're in a recession. How deep does it get? That's very hard to predict, but here's some numbers that I'm talking about and that'll be in my quarterly report, which comes out in a few days. The last, I mean, it kind of depends on when the stock market breaks, because that's the last thing. I mean, one thing I think is interesting is that the tax receipts are pretty much flat with record real estate prices and record stock market. So you want to know when this is going to really get bad, Gary? This is going to get bad when this stock bubble bursts, and it really is an everything bubble based on all the cheap money. And I know that because we had two examples of it. We had the 2008 example and we had the 2010, or we had the 2000 example. In both cases, GDP went down, 5 to 10%. Tax receipts fell, 15 to 30%, right? And government spending went up 15. So we're running, what's amazing to me is here we are running $2 trillion deficits with, quote unquote, a relatively healthy economy with relatively low unemployment. Imagine what happens when the shit hits the fan, right? I mean, to answer your question broadly, it's not going to be pretty. I mean, we're
Yeah.
gonna, they're gonna, unemployment is gonna go up quite a bit. Inflation is not going to abate. It's going to go higher because of, the yield curve control and so forth. And the deficits are going to blow out. And I think finally that's going to really start to hurt the dollar. Now, it's funny. Brent is a friend of mine, and I respect him for his dollar milkshake theory. But I've often said that's really just that's not relevant. That's you're looking at the dollar, you're looking at fiat compared to a bunch of other fiat. It's kind of like who cares?
Yeah.
I mean, yeah, okay, so their fiat's worse because they don't have the military. I get it. What you really got to look at is fiat compared to sound money, and the sound money alternatives are, gold, silver, and Bitcoin. And if you look at those three things, they're all at or near record highs. I mean, gold's at a record high, silver's got a little ways to go, Bitcoin's close. And those are the things you want to compare the dollar against. And that's what will tell you, how much inflation we have and is the dollar failing. And I think the answer is we're on a path to the dollar ultimately failing, but not tomorrow. I mean, these changes take decades. I mean, we surpassed Great Britain in the early 19th century. It took 2 or 3 decades for it to occur, and I think it's going to be similar this time. I mean, one thing people ask me, what's your timing on all this, Larry? And I think an interesting data point is fourth turnings tend to last about 20 years.
Mm-hmm.
If you look at the prior ones. And if you think this one started in '08, which I kind of do, that would imply that maybe we get some resolution late this decade, early 2030 area. And I could see that. I think the problems just keep getting worse and worse. The inflation gets worse and worse. Everybody's screaming, good God, solve this inflation problem. And then bingo, we do. We're going back to a gold standard or Bitcoin, something. We're going to a sound money standard because we've shown that this unsound money creates a lot of misery, right?
A lot. Yeah. And it's real people, real lives.
Oh, absolutely. It's horrible.
It's
Yeah.
horrible. So late, you were talking about the banking issues a little bit ago.
Yeah.
Late last week, there was a bank stock sell-off. As banks have been reporting earnings, many have been warning about credit loss, a clear sign that the economy is likely not doing well. As JP Morgan recently stated, we set aside $3.1 billion in provisions for credit losses, 62% higher than the first quarter. The commercial real estate issues are significant. They're all over the country, and regional bank balance sheets seem to be directly in the line of fire for those. What is your analysis on the banking situation as a whole? How bad is it really, and what can we expect the ripple effects to be?
Another great set of questions. So I've thought about this a lot. The Silicon Valley Bank, that wasn't just a one-off. I mean, we had a bank that got in trouble, and of course, first of all, they violated Dodd-Frank. They outright broke the law, okay, and bailed it out, as of course they had to. And I've got a friend in D.C. who's pretty well connected, and I think, probably drinks beers with some people who work at the Federal Reserve, and he has told me that he believes that there's been some internal work there to think about a CRE bailout, facility. And the notion, as we all know, office buildings all over the country are in deep shit, because of what we're doing right now on Zoom. People aren't going into offices, people aren't renting as much office space. So, there's a great follow on Twitter called Triple Net Investor who always is talking about how, you've got these $200 million buildings getting sold for $60 million. Well, somebody owned the note on that building,
exactly,
and they're losing, and $140 million is going to money heaven, right? And the somebody in many cases are the regional banks. And so, and there's a good chart that shows that maybe $600 billion is at play here, over most of the regional banks around the country. And so I think there's a chance with the next downturn that we could see a lot of regional banks get into trouble. And of course, the Fed wouldn't like that, and the FDIC wouldn't like that. And so what my friend suggested is that maybe they're talking in D.C., and this wouldn't surprise me at all because we noticed how they put together a program, a buy the paper, program for Silicon Valley Bank, right? They'll do the same thing for CRE. Okay, regional bank, you've got a loss on a CRE loan, fine. Repossess the building, we'll make you whole, we'll give you 100 cents on the dollar, and now we own the building, and we'll work it out very much like we did with the savings and loans. So. I could see something like that occurring, and it wouldn't, if I had to guess as to what the next, trigger event is for the next, what I call the big print, that CRE would be my guess.
So to sum up, fragile and high risk at this point is.
I think so in the banking system. Yeah, and also at the consumer level too. I mean, if you look at the credit card debt, how much it's gone up, and then you look at the average interest rate, I mean, I think the consumer is very much out over their skis.
Yeah.
And there could be some serious loan losses there, I would imagine.
So let's shift over to gold. Yesterday, gold broke out hard. It reached an all-time high of 24.67. Central banks have been big buyers, right? Yeah, me too. Yeah. And so have Asian, Indian, and Middle Eastern citizens. But, I guess we talked about this. What's the price level that gold needs to be at? You said 3,000.
I think 3,000.
I just want to see, at some point, they've got to sit up and they've got to be like, something's going on here with gold. Maybe it really isn't what I thought it was.
Right. And it might be, I'm guessing that is starting to happen right now, because I think when we squirted from 2070 up to 23 or 24 and it backed off, there were probably a lot of investment managers, a lot of investment committees that kind of said, oh yeah, okay. So there was a little bit of a panic in the gold market and it broke out, but it'll come back down to 2,000. And I mean, I remember I follow a guy named Gary Savage, who I respect. He's a good technical analyst, but his view is, hey, guys, this thing's got to correct very deeply here. We're going to go right back to where the breakout was. And I was kind of like, I'm not so sure, Gary. That's not always how this market operates. And so there was a lot of thinking that we were going to retrace it all, and we didn't. And here we are making new all-time highs. And so that's the kind of thing that changes people's minds. Do you know what I mean? And, of course, by the time everyone's like, oh, my God, it really is a gold bull market at 3,000, that'll be the first correction,
Right.
And then we'll correct back down to 2,500. But the point is, there was a lot of skepticism on the breakout, and I think we're in the process of watching that skepticism get disabused of the notion that we're going back to 2,000, because we're probably not. So.
Well, Larry, like you said earlier, it's that wall of worry, and it's definitely being climbed.
Right.
So we're seeing a multitude of technical breakouts, as Tavi Casa has spoken about in the precious metals industry. He's got all these wonderful charts: the miners to gold ratio, the junior miners to gold ratio, silver in and of itself, and the gold to silver ratio. They're just a few of what's been experienced as far as technical breakouts recently.
They're huge.
It's huge. Yeah. Would you speak into your expectations, what your analysis is pointing to over the next 12 months for precious metals?
They're all going a lot higher, but I want to emphasize how bullish I am on silver. Okay, let's go there for a minute. I mean, I just checked it out. We're mining 7 ounces of silver for every 1 ounce of gold. Okay, that's not, and it's getting used up, and the stockpiles aren't very large. I mean, the one thing to consider about gold is we've got huge stockpiles everywhere. Silver gets used, and if you look at the solar demand out of China, it's growing really consistently, and it's getting used in automobiles, and silver's used in a lot of different places. And so, and historically in bull markets, when they really do come in the precious metals, silver, just soars vis-a-vis gold, and the silver gold ratio is still pretty close to 80, which is quite extreme.
Right.
So while I'm quite bullish on gold, I'm just crazy bullish on silver. I mean, it's the one commodity that hasn't even taken out its all-time high, from the prior 30, 40 years. I mean, the Hunt brothers ran it up to 50, and then 2011 it ran up to 50, and it's in the low 30s right now. I mean, I fully expect that we're going to see $100 silver here in this cycle, and not as far out as people think. I mean, probably within a couple of years.
So you're talking about all the demand. I mean, the massive data center build out that's needed for AI, the electrification of everything.
Yes.
You mentioned the boom in solar panels, the rising advanced weapons manufacturing that's happening globally. All of this requires silver. There's 120 million people in the Asian circle that over the next 3 years is going to rise up from poverty to the consumer class. Everything that they're going to buy is going to include silver. But the inflation adjusted high for silver is about $175.
Right.
So we're sitting around what you said, $30, $31, maybe 31 and a half. I don't have it in front of me. So we're 5-6 times below the inflation adjusted high.
Yes.
If we break out of that, where could it possibly go?
Well, it could go even. I mean, longer term, my numbers are much higher than 100. I'm just talking the next year or two. I mean, Another thing I think we should focus on, Gary, because I know you mentioned it when you were discussing this with Jesse in your last interview. There's been underinvestment in this stuff. I mean,
Right.
And Tavi's got great charts on this. I mean, we haven't been adding to our silver mining capacity. I mean, it's been shrinking, and you have to remember that all these mines, are depleting resources, and you have to continually make new discoveries. And then if you want to produce more, you've got to invest capex, and capex in this industry has been falling for multiple years now. And so there's really kind of the perfect storm of falling supply, increasing demand, and we're coming off a fairly low price base. I mean, yeah, I mean, silver was as low as in the low 20s, 6 months ago or something, and it's 30 something today. So we're up, nicely, obviously, and 50% move. But in my opinion, we've got a very, very long way to go. And as you say, the inflation adjusted price is much, much higher. I mean, look, I just take it kind of 1 or 2 years at a time. I think, history says when you're in a bull market that it will surprise you to the upside. I mean, I think, look at what happened to the price of Nvidia. Look at what happened to the price of Tesla. Look at, when it becomes clear to everybody that a trend is in place and that it's going to run for a while, the prices will do things that you didn't even begin to expect.
Yeah.
So, and those are good for you, right? I mean, throughout my career, I've made all my money by investing in things and thinking, this is a pretty good bull market, this is a pretty good trend, and if I put some money here, I'll probably make 2 or 3x my money. And I can't tell you how many times thinking that I ended up making 5 or 6x just because I got lucky and people overpaid.
It's likely to happen again and repeat. You mentioned it earlier. History has a tendency to rhyme. When I think about the decentralization of what's happening around the world, it's very possible that some countries, especially the largest manufacturing country in the world, could see the critical importance of cornering some or a good majority of silver. There are technology companies that, with the data centers and the electrification of things that they're building, that they may be cornering. And then you have the monetary situation and the investors coming in. Can you see a scarcity event?
Absolutely. Absolutely. Place? I mean, and think about it in dollar terms, Gary. I mean, the silver market's a dinky little market. I mean, I can't remember the exact number now, but it's 800,000 or 800 million ounces per year.
Right.
Multiply that times 30. What's that? $2.4 trillion. I mean, stock market's a $130 trillion market. I mean, it's,
And then the bond market is
the bond market's another $100 trillion. I mean, it's, it doesn't take much, right. To move this thing.
So I want to ask you another question on gold.
Actually, I think I'm wrong. I don't think it's trillions. I think 800 million times 30 might be billions. Might be $2.4 billion. Am I right about that?
I think the silver. I think it's 800.
Do it in base millions. 800 million at 32. Okay. Yeah, it's 25.6 billion. Yeah.
So the Dow to gold ratio is historically overvalued when the ratio hits 20 to 1. It currently sits around 17 to 1, which ironically is approximately bullseye for where it was at the 1929 peak. Right. During the depths of the Great Depression, the Dow to gold ratio dropped all the way down to about 2 to 1. And when interest rates peaked in 1979, it dropped almost all the way down to 1 to 1, meaning 1 ounce of gold equaled one share of the Dow. Larry, with its currently around 17 to 1, where are you expecting the Dow to gold ratio to go over the next few years in this cycle?
Yeah, it's a great question. I don't know the answer, but let's say let's say it doesn't do the 1 to 1, or let's say it does the 2 to 1. If the Dow were to stay where it stays, that would imply $20,000 gold. I mean, it could be we have a melt up though in the Dow, because we've got a crack up boom and we have 100,000 Dow and 50,000 gold. I mean, all I know is that gold just has to be priced much higher. I mean, a number I like to cite just to give people a perspective on how much paper money we've printed and how undervalued gold is as follows. If you take a monetary aggregate from the 70s, that the most widely used one at the time, and you divide it by the 261 million ounces of gold that the United States Treasury owns, you came up close to the $35 an ounce. So there was actually some I mean, it was a little higher than that because we cheated after Bretton Woods, but that was the Bretton Woods number and abandoning the gold standard. $35 an ounce was the price of gold. If you do that same math today, you take M2, the broad money measure, and you divide it, gold would have to be $80,000 an ounce. Okay, that's how much money we've created. All right, there's a lot of M2 out there, and we haven't added nearly as much gold. So, I'm not suggesting gold's going to 80,000 an ounce, but I'm trying to give people some perspective that, which side of this bet do you want to be on, right? I mean, that's all. I mean, the nice thing about investing is you don't have to get it absolutely right. You just want to, generally speaking, try to be on the right side of a bet. And you want to be on a bet that's somewhat asymmetric, where if you're wrong, look, if you're wrong in gold and, it goes down, I mean, it's not going to zero because it costs money to mine it, but, so you buy it at 2,500 and it goes to 1,800. All right, you lost a little money, but you've got probably 3x the upside and 30% downside. I mean, that's generally speaking the kind of investment bet you want to take. I look at NVIDIA as a comparable. I mean, 41 times revenues. I mean, what's NVIDIA going to do? Go to 80 times revenues or 120 times revenues? I mean, it has to go to 120 times revenues to get a 3x. And, if it went back to a normal revenue multiple, you'd lose 80% of your money. So, my view is asymmetry is what we're looking for here.
So let's stay on that asymmetry concept. The gold and silver miners have had a very rough last few years, to the point where many experts who have recency bias, they're suggesting the miners won't come along for the rally in gold and silver. That has never happened in a gold and silver, rally that's sustained. In fact, when gold and silver are in a sustained and strong bull run, the miner's torque to the underlying metal produces breathtaking returns.
Absolutely.
Larry, what does your analysis point to for the miners in this precious metals bull run? Will it compare with the 70s and early 2000s in your estimation? And how long do you expect that this bull run will last?
Great questions. I think it will compare to those. I expect the GDXJ to double within the next 18 months. Yes, as you pointed out, the miners do provide torque because they represent a stream. Good ones represent a stream of the metal. The rule of thumb is always, as you know and I know, has always been if gold goes up 10%, the miner should go up 30%. So it should be kind of a 3x torque. I know people are down on them. They've been dogs for 3 years now. They don't work well when the price of the metal's not going up because their all-in sustaining costs are going up. They did great I had great years in 2019 and 2020. Metal went up faster than the cost. I mean, they're spread businesses. It costs money to pull gold out of the ground. You got to sell it and when that spread's increasing, they go nuts. And right now we're in a period where that spread is increasing because ASICs are going up, but at 10% say a year, and the metal is going up much faster than that. So to your question of how long it's going to last, I've tended to notice kind of 4-year cycles. In these things. I mean, we broke out in 2016. We had a pretty good cycle into 2020. They tightened from 2020 to 2024. We kind of went sideways to down. I gave back a lot of the gains I'd gotten. We now appear to be kicking off another cycle. I feel like we're probably good into 2027, 2028. But maybe at that point in time, we get into some monetary reform and they start to try and balance the budget. And I don't know. We'll just have to play it by ear as it goes. I feel, here's what I will say, Gary, with high confidence. I feel very good that the next 2 years are going to be really good for us. Yeah. I think, we are in front of a freight train. I mean, let me explain why. I've got companies that are trading at 3 times cash flow. And these are companies that will benefit from a higher metal price, meaning they'll make more per ounce. They'll benefit because they're going to produce more ounces. In other words, they're investing in increasing capacity either in their existing mine or in a new mine. And they'll benefit because 3 times cash flow is too cheap and they'll get multiple expansion. So grow the margin, grow the production, grow the multiple. And this is how one gets, 5 to 10 baggers, right? I mean, that's why. So I've heard people say it's a tough business, and it is. I mean, there's an argument that says you should rent gold stocks, but I'll tell you, now is when you want to rent them. You want to rent them when, the multiples are low, the metal's going higher, and the good ones are increasing their production. And that's kind of what I'm focused on.
So, what trends are you watching for to play out over the next year, and why is it important to both the economy and markets?
Whew. Well, I'm obviously watching what the bond market's doing, and I'm watching what the stock market's doing, and I'm a little bit aware of the risk of, the stock market really breaks, and we kind of we have another one of these kind of deflationary scares slash events, which would, by the way, hurt the gold stocks too. I mean, as an example, in March of 2020. That was for a very brief period of time before Powell came in with his enormous, money print and all the accommodation. I think I was in the triple leverage GDXJ product, and it friggin' blew up, right? Because as you'll recall, gold went straight south on the COVID news, and the gold stocks did too. And, so if we have an enormous inflationary event and scare, there could be a very brief period of time where we got to hang on to our hats and be willing to swallow, a 20 or 30 or even a 40% drawdown. But I think it's safe to say that in that deflationary scare, we know with very high probability the way that the authorities would react to it. And that reaction would be, to come in with the biggest money printer you've ever seen. And that coming out of that, I mean, that downturn in March of 2020, I recovered from it in a month and a half. So, that's the only caveat I would make with respect to owning these stocks is the possibility of a negative deflationary event where people sell, not what they want to sell, they sell what they have to sell. And so everything gets sold, including our stocks.
Yeah, yeah. Well, this has been a wonderful conversation. Before we wrap up here and I ask Larry our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free
I love that
gift
quote.
is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.
Yeah.
Also, I'm positive that you've enjoyed this conversation with Larry as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, it's now time for our Golden Nugget segment. Larry,
what's that?
Let's discuss portfolio positioning based on
Sure.
all we've discussed today. With your experience, your worldview as the backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
Okay, well, let's do the stay away. So I just forget long duration bonds. Okay, if we're entering the inflationary world that I know we're entering, or I believe we're entering, long duration bonds are just going to be total dog shit. So you want to stay away from that. The stock market, I believe you want to avoid it, but I understand why some people always need to be there. So fine. I mean, it does represent a claim on a business, and some of those businesses are monopolies. So, I understand why one would want to own Google as an example. I think the best investment play right now in the market in the world are gold and silver mining stocks. And within that, I really heavily tilt towards the silver because of what we discussed earlier. I just think there's a lot more torque in the silver price. I've got a lot of companies where their ASICs on their silver production are in the mid-teens, mid to high teens, low 20s. And guess what? A $60 silver price, these companies are just going to mint money. Yeah. It's going to be unbelievable. So, I would say that, for the, within that, I would lean towards silver. Within the where to be, there are I put miners into three buckets. There's the drill story bucket. There's the producer bucket, the developer bucket, and there's the producer bucket. For amateurs or anyone who's not familiar with the space, I would say stick to the producers. They generally speaking have cash flow. They don't need to continually raise money the way the drill stories and the developers do. And my sweet spot is a medium-sized, small to medium-sized producer that has positive cash flow, that no longer needs to raise money from the market, and that is using their cash flow to expand their production or build another mine. Those tend to be, in my opinion, the best kind of risk reward sweet spot. For those who want to, gamble a little or understand the business well, there are obviously drill stories you can pursue, there are development stories you can pursue, but beware, those don't always work out. And sometimes, by the way, the producers go south. I mean, I love Victoria. I know John McConnell well, and tragic what happened there. And this is the mining business, right? I mean, things do go wrong, and that's why it's important to own a large number of these, because you can't think, well, I'm going to pick the 3 best mining stocks and that's that. It's impossible. Some of them are going to break, and sadly you don't know which ones. And you want to make sure you're in some of the other ones, because you don't necessarily know which one's going to do a 10-bagger either. You want to make sure you're there. So I like silver people a lot. They're the big easy calls. Coeur, Hecla, Pan American. And although even these companies aren't all pure silver anymore. I mean, moving more towards pure silver. I like Avino a lot. I like Endeavor Silver a lot. I like Guanajuato Silver a lot. I mean, there are companies that are more. I like Silvercrest. I like Silver Corp. Silver Corp is stunningly undervalued, and I think it's because it's a Chinese. They operate in China. I don't foresee that as being a problem, but some people do. They think that we're going to get in a war with China over Taiwan, and but I don't see it as being a problem. And I think Silvercorp is a stunning value in the silver mining space. So it's I guess that's what I would lean toward. If you're looking at picking stocks in this area.
Well, like I said, this has been an absolutely wonderful conversation. Larry, thank you for coming on to the Metals and Miners podcast, for being so generous with your time, analysis, and ideas. It's been fantastic. Would you please share with the viewers, what's the overall theme you want to leave with those watching? Where can they learn about your work, and how can they connect with you?
Yeah, sounds great. So the overall theme is sound money is a really important issue to make our society better in every way, and the government can't stop printing money. It's mathematically assured. They're going to debase your money. So if you have any savings, you need to put it into silver, gold, or in my opinion, silver and gold mining companies. Bitcoin also I believe in very strongly. I think it's a digital form of gold. I know some gold people don't buy that, but I do. I'm a big Bitcoin fan and supporter, so I think it's a great diversifier. In terms of following me, my partner and I read a quarterly letter that discusses all these things. It's free. It's macro letter. You can get on our mailing list, and we'll send it to you. We'll never spam you. And to do that, one would go to my website, which was EMA, which Equity Management Associates, EMA, the number 2.com. You just enter. The past letters are on there, so you can read them for free. You can put in your email. We'll shoot you out the new one. The new one should come out in a day or two. We're finishing it up right now. And then the final thing is I'm on Twitter, just under my name, Lawrence Lepard. I make a lot of noise. My major complaint, I think what the central banks have done to the monetary system and therefore to the country, I think it's just criminal. I think they've torn the fabric of this country apart and hurt just millions and millions of people. And we've absolutely positively got to end the Fed. And I'm writing a white paper / book on that topic, and it should be done within I'd say a month to 2 months. And when it's done, I'll announce it on my Twitter feed. And I'm thinking about just making it free as a PDF. People can just read it and pass it along to their friends. I think that as citizens, the one thing we can all do is bitch like hell that we've got to get to a sound money standard, because it's not blue-red. That's not the issue. I mean, there are issues there, but that's not the primary issue. The primary issue is we went off the gold standard in '71, and in my opinion, since then, this country's gone to the shitter. And we got to get back on a sound money standard.
Well, I appreciate your viewpoints. I'm going to put all the contact information up on the screen. I'm going to put it in the description for everyone to be able to click through and get over to your Twitter, to get over to your website, to be able to get to your newsletter. Everybody, you need to follow Larry. He does make a lot of noise, but the noise is important noise. It's a very detailed, analytical, and big macro picture viewpoint, and it's one that you need to take in. You probably align with it if you're watching this channel, but you need to take it in, and you need to make Larry a regular part of your research. So, Larry, I look forward to having you back on. Thank
Gary,
you.
I'm happy to do it anytime. I'll go anywhere, any place to talk about sound money.
Yeah, well, thank you for being here with us, and everybody else, thank you for watching.
Yeah, thanks, Gary.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If you don't own gold, you know neither history nor economics." This free
I love
gift
that quote.
is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.